Lululemon stock is down 15% recently as the company hit a record revenue, margins, and cash flow. Why? Street wanted a little higher growth, but this company is still growing. Currently trading for $300. I think this company's worth $1,000 or more. I'm going to show you why. If you bought the stock today, held it for a decade, you can make some serious jack. Ready? Let's get to work. Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, let's spice things up. Let's take a look at Lululemon. I've just posted in the Cash Flow Club my analysis of the stock. The stock is down 15%. One of our Cash Flow Club members called that out. He's absolutely right. The stock is down. We need to take a look at it. We looked at it about 2 years ago, liked the stock, but thought it was basically even with market. Let's figure out what this drop has done, especially after their record-setting earnings. Before we dive into the analysis, I do want to level set for this channel, right? We are rational investors. We look for equities that we can buy that are going to, over the long term, appreciate. What is long term? 10, 20, 30 years. That's a long-term investment. This is not a stock trading channel. If you want that, go see Jim Cramer. Go see lots of other people who just pump and dump stock all day long. I'm a CFO by profession. I work for private equity companies, and I started this channel during the pandemic just to kind of give an alternative to the meme chasers that are out there. I break down detailed cash flow. We do a conservative forecast, and we test for 5 key attributes that we want to see before we do further due diligence. Those 5 key attributes are as follows. Number 1, I want a company with top-line revenue growth over the last decade. You are growing your top-line revenue. Number 2, earnings growth. Enterprise-level earnings, not earnings per share, enterprise-level earnings. That could be EBITDA, operating income, EBIT. It could even be net income, but you want to see that growing. Number 3 is strong free cash flow. That's the name of the game. That's what underpins the value of a company. Number 4 is low debt. You want less than 3 times debt to EBITDA. And number 5, you want a well-priced stock. What is a well-priced stock? It's basically a stock that is reasonably priced on its cash flow. It's not outrageously expensive or completely betting on a growth prospect. Things happen and sometimes growth doesn't pan out. You want a fallback plan. That fallback plan is buying something at a reasonable price. All right, so let's dive into Lululemon, the athletic company that makes apparel. I posted here in the club just a little bit of briefly. The stock is down about 15% or so on the recent earnings. However, when you look at the 10K, the annual results, they produced $9.6 billion of top-line revenue, a 19% year-over-year growth, 27% EBITDA, which is a margin which is a very high for them, and very strong free cash flow. Let's jump through this stock a little bit. I want to run through the income statement, balance sheet, and cash flow. And then we'll look at a forecast, and I'll show you the one-pager and see what we think this stock is truly valued at. So what do they do, right? They make clothing apparel. It's a very trendy brand. Make clothing apparel, and this is just some examples of what they make. Here is where they derive their revenue, net revenues over the years. You can see most of it is the Americas at 85% in 2021. However, over time, 2022 and now 2023, that has come down to 79%. As the rest of the world and China has grown to be about 20% of their total revenue in those areas versus about 80% in the United States. Okay, let's dive into the balance sheet for Lululemon. Quick trivia fact, why does the balance sheet appear first, not the income statement of cash flow? Well, back in the day, buying bonds was the gentleman's sport, and the equities was for the degenerate gamblers. The bond investment being underpinned by the balance sheet. Equity investing is cash flow, so it's kind of the last of the 3 statements. So for all of you fellow degenerate gamblers out there, kudos to you. But we'll start with the balance sheet first because that's just historically trend. So what do they have? So this is 2024 Jan is the end of the fiscal year for them, is January 28th, 2024. And you have the same period last year for 2023. Cash and cash equivalent, they ended with $2.2 billion of cash on hand, which is an absolute huge amount of jack, and about $1 billion increase year over year in cash. Love to see that. I mean, that means that they are generating more cash than they can put to work. Great job. Total current assets, $4 billion versus $3 billion. Total assets, $7 billion, with very little goodwill. Almost zero. Right-of-use assets, these are leases for the stores. And they got $1.5 billion of property, plant, and equipment. So this balance sheet is actually extremely healthy. Most of its current assets, they have very little goodwill, and then most of it is property, plant, and equipment. Great job, great balance sheet. Let's take a look at debt. So current liability is $1.6 billion. That's extremely low, and they can pay off all of their current assets with their current liabilities. That's a great Ben Graham setup right there. So very healthy on the liabilities. In terms of long-term debt, I don't see any long-term debt here. They've got non-current lease liabilities, some tax liabilities, deferred taxes, and other. There's no long-term debt in this business, which is phenomenal to see. You don't see that very often. So what does that mean for you and I? Well, that means if you buy the equity of this business, you have the collateral position of a bond investor, but the equity-like return of an equity investor, because there's no bank debt in between you. When you look at the capital stack, it's a triangle with senior secured debt down at the bottom. You've got maybe junior debt, mezzanine, preferred equity, and then equity at the very top. Well, if you are in bankruptcy or some sort of foreclosure position, the judge and the court is going to give up the assets or the cash flow to the most secured investor, which is the bondholder, the senior secured tranche A bondholder, and then work their way up or down, however you want to look at the capital structure. In this instance, there is no one in between, aside landlords, in between the equity investors and the assets of the business. So you, as a stock owner, have bond-like security, even though you don't have a formal claim. There's no one in between you. So you have a bond-like collateral position, but you have the upside of a stock investor, which is great to see. So then you get the actual equity statement, $9 billion versus $5.6 billion. Very clean, very simple balance sheet. I really like that. All right, so as I referenced at the outset, $9.6 billion of top-line revenue, which is a monster year for them. Let's take a look at the income statement. So here we go. Net revenues, $9.6 billion for the fiscal year end January 20th, 2024. Prior to that, 8.1. Prior to that, 6.2. So in 3 years, they've gone from 6.2 billion to $9.6 billion. Great growth. That growth continues over the long term. We'll look at 10 years of revenue here in a short time, but that's nice, strong revenue performance. Gross profit, they're profitable, 3.6, 4.5, 5.6 during that time frame, those same 3 years. So gross profit, they're making money on their clothing sales, which is great. Then how do they run the organization? So that's variable costs. What does it take to actually run the facility? Well, general, selling, and administrative costs, $3.4 billion last year, 2.7, 2.2. So this is growing. They're up about $1 billion in 2 years, growing SG&A. But they also grew top line. They grew margins, so that's okay. It's probably a little strong of growth, but they're still profitable, being operating income, right? So profit. This includes depreciation and other non-cash items. $2.1 billion last year in profit, operating income. That's up from 1.3, so they gained $1 billion. This 1.6 billion of sales growth that they experienced last year, from 8.1 billion to 9.6 billion, that translated to a profit increase of basically $900 million. So they kept a lot of that increase in revenue, and it dropped to the bottom line, which you want to see. It's a great job. Prior to that, they were 1.3 billion. So they're kind of flat 2 years in operating profit, then a nice spike of almost $900 million last year. Great job. Then net income, just rounding it out, $975 million in 2022. It went up to $850 million in 2023, and then last year, $1.5 billion of net income last year. Very strong performance. We'll get into the shares outstanding later on. Let's go to the cash flow statement where the rubber meets the road. Okay, my favorite statement, your favorite statement, the cash flow statement. This is what underpins the true value of a business. This is why you buy a business. You buy a business for its future cash generation. How do you measure that? Well, there's three sections to the cash flow statement. There's the income, there's the operating cash flow statement where you make cash from generating your operations, your investing cash flow statement where you invested that money, and the financing section of the cash flow statement, how you finance that business, what you did with the free cash flow. So in the operating section, it's always the first third of the cash flow statement, and it's usually bold at the bottom, and it says net cash provided by operating activities. You always want to look at this. This should always be positive. This should always be growing over the long term. That's what you want to see. And it should dovetail with the income statement. They should match each other. As one goes up, the other should go up. $2.3 billion of operating cash flow last year. I want to zip through here to see if they have anything like impairments or stock-based compensation. Here we go. This is always a big one, especially in the tech sector. $93 million of stock-based comp. That is very low. And I like to see that. That means that the management company is treating the stockholders like partners and not frittering the value of the business away, giving it to the employees, but actually treating investors like partners. And that's a very key point. So they made $2.3 billion of pure jack last year running their business, manufacturing clothing, selling their clothing, running their stores, paying the executive staff, marketing, legal, taxes, all that stuff of running the business. After the end of the year of operating, the result of that year is an extra $2.3 billion of cash. Prior to that, it was $966 million. Prior to that, it was $1.4 million. So a little dip last year, but rebound nicely this year. Now, what do they do with that money? Well, you've got two other statements that you can do with the income statement. This can be the investing statement or the financing statement. So let's take a look at net cash from investing activities. Right here, $654 million. Well, the big thing you want to look at here is the purchase of property, plant, and equipment. Don't worry about the net settlement of hedges or other investing activity here. Companies with large cash balances have to invest that money. And when they buy an investment and that investment matures and they put it into a different investment, that is a change in investing. And it's called out in this statement, but it's really just re-bucketing money around their checking and savings account. It's not new investments. So you really want to focus on this line that says purchase of property, plant, and equipment. You might also see one that says purchase of software, but those are the investments into the business that you want to look at. So what happened last year? Like I said, they made $2.3 billion of cash generated in their business, and they have a giant pool of money sitting there. They peel off $651 billion here, investing in property plant. They go build stores with it. They built 17 stores last quarter, if I'm not mistaken. 13 stores last quarter. They have a total of 711 total stores. Well, part of what they're doing here is they're taking this cash and they're building stores for growth. They're putting in ERP systems. They're doing more manufacturing lines. They're buying trucks. They could be buying infrastructure that helps generate the cash flow. That's what you want. But the point here is after this $2.3 billion minus $600 billion is like $1.7 billion of cash. That is absolutely free cash flow. As one managing director that I worked for when I was just an analyst said, you could light free cash flow on fire and it would not affect the business. That is the true meaning of free cash flow. You could literally burn it and the business would be unaffected. And if you take cash flow from operations minus the property, plant, equipment, you get about, for this company, about $1.7 billion. That money could be literally burnt on fire and it would not affect the business. It's true free cash flow, and that's a lot of money. That money flows through to pay debt and to pay dividends or to buy back shares or sits in the balance sheet as free cash flow. That's the only thing they can do with it. Those four options. What do they choose to do? Well, cash flow from financing activities right here explains what they did. You do not see any payment of big debt. They have no debt. So check that off. They don't have to pay anybody. That means that free cash flow goes to sit on the balance sheet, goes to buy back shares, or pay dividends. Let's see what they got. They have proceeds from the settlement of stock compensation. Okay, so they paid out a little bit of stock. Shares withheld for net settlement of stock compensation, so that's still stock comp. Repurchase of shares. There you go. They spent $558 million buying back stock last year. Well, prior to that, they bought back $444 million of stock. Prior to that, they bought back $800 million of stock. And other activities, which is almost zero. So all they did, the only thing they did is bought back stock. They don't pay a dividend. They have no debt. They bought back stock. And where did the rest of the cash go? It sat on the balance sheet. That's how they ended up with that $1 billion cash increase year over year in the balance that I covered at the outset when we were talking the balance sheet. They generated about $1.6 billion of free cash flow that could be burnt on fire. Remember I said that? Minus $560 million for stock-based comp. The rest of it sits in the balance sheet. So this company is generating a lot of free cash flow. It does not take a lot for them to put back into the business, which means a lot of the cash is left over for you and I stock owners. What are they doing with it? They're buying back shares and they're building a war chest basically on their balance sheet as that cash balance continues to grow. So really clean. Like I said, balance sheet was super clean, mostly was current assets, no debt, no goodwill, stuff like that. They have strong cash generation, revenue is growing, top line, bottom line, margins, very nice. Let's figure out if this thing is reasonably priced. Let's zip through to the cash flow one pager, take a look at my forecast and why I believe the stock could be worth about $1,000 out 10 years from now. Okay, now we dive into the cash flow one pager. What is a one pager? Well, I have a website, cashflowinvestingpro.com, where I and a team of analysts create one pagers. They look like this. It includes 10 years of historical financial information. It includes a 10-year forecast. It shows you earnings and free cash flow and the assumptions around the long-term forecast. The reason I dislike a lot of the Wall Street forecasts is they simply put out a number. They don't tell you what the assumptions are underneath that number. And I'll tell you why I did it this way. When I was an analyst, I was working on an IPO and Goldman Sachs was the underwriter. Not to knock these guys, they just happened to be the underwriter. But I got a hold of their forecast model, what they were using to underwrite the securities that we were going public with. And I looked at the model. I thought the model was extremely aggressive, that a more diligent, more rational person would have pulled back the growth in this model a whole lot more. However, the investors never really saw the forecast model. They simply see the number that's out there or a couple bars of growth and not really the full assumptions that underpin the risk of the investment. So I said, you know what, if I'm going to do it differently, I'm going to show all the assumptions. And that's what we do here, and I'll cover those. But we cover lots of one-pagers. So we've done, like, for example, Waste Management, Salesforce, we've done Nike, NVIDIA, Under Armour, a whole bunch of Altera Group, Advanced Micro Devices, a whole bunch of companies that we cover, over 150 stocks. By the way, if you want to become an analyst, email me. There's an email down below. We had one of our analysts just get a great job at a top money management company for being in the club and some of the postings and work that he was doing. Great job to him. But enough about that. Let's dive into Lululemon and see what we get. So behind me is the 10-year summary. I'm going to go quickly because we just dove through the full detail of the income statement, cash flow, and balance sheet. But I do want to cover it. So down this section here, I've got revenue. Revenue since 2015. This is 10 years, 2024 to 2015. In 2015, the revenue is $1.8 billion, and that has grown almost every single year for the decade. I'm going to read this off. Starting in 2015, 1.8 billion, 2 billion, 2.3 billion, 2.6 billion, 3.2, 3.9, 4.4, 6.3, 8.1, and $9.6 billion. That is a growth in revenue. Every single year for a decade, the average annual growth rate of revenue for the last decade has been 20% annualized. That, ladies and gentlemen, is one heck of a track record. 10 years of growth in revenue every single year is a very, very difficult achievement. Great job, Lululemon team, for pulling off that one. I congratulate you for that success. Let's see how it translated to earnings. EBITDA, earnings before interest, tax, depreciation, and amortization. This is our estimate of operating profit. I don't like earnings per share because you can manipulate that. It's just a denominator. It's just a fraction of net income divided by shares. And if you buy back shares on flat earnings, you can artificially increase earnings per share. I think that masks underlying weakness in a business. People like Coca-Cola or McDonald's does this a lot by buying back shares to make flat earnings look like they're growing. I would rather buy a company that's growing earnings naturally and then on top of that buying shares. So it's a preference. So let's take a look and see what we get. $428 million of EBITDA in 2015. That grew to 431, 517, 600, 828, 1.1 billion, basically 1 billion again. 1.6 billion, 2 billion, 2.6 billion. So growing every single year with that 1 year that was flat year over year. Average annual growth rate of profit is 22%. So margins are expanding because profit is growing at 22%. Revenue is growing at 20%. So you've got 10 years of revenue growth, 10 years of profit growth, and margin expansion. Great job. Debt is basically zero. The only thing you see here, 1.4 billion, those are the capital leases for their retail operations they have to capitalize. But as far as bank debt goes, it's zero. Excess cash, they have 2.2 billion on the cash. I'm saying 1.2 is excess, could be dividended out and not impact the business. So you net these two, it's zero net debt. Market cap has gone from basically 10 billion to 60 billion over the last decade. That's a 6x return, great job. And the enterprise value is going to be the same because the debt is net to zero. What is enterprise value? What is market cap? Realize that when you look in the stock market, what trades the equity is the market cap. And it ignores any debt the business has on it. So there are many businesses that have lots of debt that you cannot see because you simply look at the stock price. Always look at enterprise value. A couple metrics here. Debt to EBITDA is a risk of bankruptcy. You want to see less than 3 times. Why 3 times? Because a senior lender, JP Morgan, a Citigroup, a Wells Fargo, a Chase, these guys will lend 3 times debt to EBITDA on a business, as that's considered senior secured lending. After that, you get into junior, mezzanine, preferred, blah, blah, blah. As you go down the capital stack, we want businesses that have less than 3 times. So room or capacity to borrow still at a senior level. These guys have 0. Great job. Enterprise value to EBITDA, this is a relative value metric that just shows how many years forward are you paying for earnings. This business has traded as high as 43 times earnings, as low as, say, 17, averaging 25. It's currently at 17 times forward earnings. It's why I think it's got an opportunity for a market multiple expansion, part of the trifecta that I'll come into later. So I think it's reasonably priced from an enterprise level. Let's take a look at free cash flow. Again, I'll go through this quickly because we kind of already did this. Adjusted free cash flow. We adjust free cash flow by removing stock-based comp or treating it as a cash cost just to be more conservative. It really impacts a lot of the software businesses that pay people in stock and dilute the equity owners. A business like this doesn't really affect it. $2.2 billion of free cash flow, average annual free cash flow growth 25%. You'll notice that number is very close to earnings. This is important, very important. It means when you have long-term growth rates in free cash flow that line up with long-term growth rates of the income statement, that means the accounting team is doing a great job expensing expenses as they come in relative to cash. They're not treating things differently like the Enrons of the world or so forth that will kind of like mask what's going on behind the business. This smell checks to me correctly have similar patterns in cash generation as you do on the P&L. So 2.2 billion, that's up from 300 million last decade. Continued growth, very strong. CapEx has likewise grown, but grown at a slightly smaller rate, so margins are expanding. Great job. No debt. Free cash flow, $1.6 billion of free cash flow. I quoted that earlier when I said that they bought back shares and the $1 billion increase in cash. There's your $1.5 billion. Last year, they had the dip to 250 million. Prior to that, 925 million. So large and kind of stepwise growing free cash flow. What are they doing with the money? They are buying back shares, albeit a little bit. I think they could be more aggressive with the share buyback. They had 144 million shares outstanding earlier in the decade, and that's come down 141, 137, 136, 134, 131, 131, 130, 128, 127. That's an average annual decline of 1% in the shares as they slowly buy them down. Okay, so if you take free cash flow, you divide it by shares, you get free cash flow per share. This is what underpins the true value of a business. You want to see it positive and growing. You're buying the future stream of that. That's how you price your business. And you can see they spiked last year, $12.2 billion of free cash flow. That's up 10 times what they had earlier in the decade of 1.29. Very strong growth. Great job, team. And then you can see here's the share price has been $66 earlier in the decade. It was $453 at the end of the last fiscal year, which is January. It's dropped down now. You can buy this stock for $400 a share, which I think is a very interesting opportunity. Yield here is low single digit, so it's not a high free cash flow yielding business. They make cash flow, but the shares do trade at a premium to that cash flow. So here's the overall one-pager. Let's check out the forecast for Lululemon. Okay, let's forecast this business. We forecast on two methods, EBITDA and free cash flow. EBITDA here, I'm saying they've got a 15% year-over-year EBITDA growth rate. So they take the $2.6 billion of EBITDA that they earned last year. They're going to grow that to 2.9, just shy of $3 billion. And over the next decade is really what we want to do. They're going to grow that to $6 billion. So they're basically doubling from next year the EBITDA over 10 years. How is it going to happen? Is it up consistently? Is it down? Is it 20%? Is it 12%? I don't know. Nobody knows. What we're trying to do here is out 10 years from now, I need this business to generate $6 billion of EBITDA. Is that realistic? Yeah, I think given what they're doing with a 22% annual growth rate, they did 19% last year. I'm saying I need 15% and I'm dropping that growth rate over time. That seems right to me. I'm attaching a market multiple of 20 times this. Average was 24. They're currently at 17. So I get a market multiple expansion over time. And it gives me a stock price of just shy of $1,000, $980 a share with an EBITDA market multiple method out 10 years from now. On a free cash flow basis, here's a little tricky. So you'll see last year they made $12.2 per share. Prior to that, it was $2. Prior to that, it was $7. So cash flow does move more wildly than earnings because it's cash-based, not GAAP-based, that allows smoothing. So do I want to pig off the 12 and say that's going to grow at 15%? No, I want to be conservative. So I'm averaging these last 3 years, 7, 2, and 12. I get an average of just shy of 8. I grow it at 15%, I get $8.15. That's how I get a little bit more of a conservative guess at where cash flow is, and then from there I'll grow it. And I'm saying that needs to be $17 out a decade from now, which I think is reasonable, very much so. If they hit 12 back that last year, they should be able to get this thing out 10 years from now. I put a 2% yield on it, I get $852 a share. I average those two, I'm thinking long-term guess. Nobody knows what the future is. This is pure, guess with some sort of rational basis. I think the stock could be $916 out 10 years from now, or about $1 billion, or about $1,000, like I said at the outset, out 10 years, very, very possible. Well, I can buy all the stock I want at $400 right now. So if I bought the stock at $400 today, I get a stream of cash flow that is mine proportionally. They can dividend it out, which they haven't started yet. They could buy back shares, which they are, or they could store it on the balance sheet, or they could make acquisitions. But if they store it on the balance sheet, I would still get it because it would represent itself in the stock price. So I get this stream of cash flow. That's a 12% IRR, which is a market-beating IRR. Remember, the S&P 500 over any 10-year period of time over the last decade has done about 10% return. So here at a 12% IRR, you're beating the stock market by 20% over a decade. I think that's a very strong return for a very strong company. Let's review our 5 key factors. Number 1, top line revenue growth. Yes, it's growing, check the box. Number 2, earnings growth. Earnings growth are very strong, check that box. Number 3, strong free cash flow. Cash flow is there, trades at a low free cash flow yield, but the cash flow itself is strong. Number 4, low debt. Debt is 0, great job. Number 5, well priced. Yes, this stock is well priced because with a conservative forecast, which I think this is, conservative market multiples, I get a market beating forecast. I think that means it is well priced. I'm going to give this a good. I like this stock. I liked it back when it was $300 a share. I did a video 2 years ago. I like it now at $400. I think this company has a lot of runway, and you as an investor are protected because there's no debt there in front of you. So you have, again, a bond-like security with an equity upside on a business that's growing double digits annually for the last decade. That's a very compelling argument, in my opinion, and paying 17 times forward earnings for that, or about 2% free cash flow yield, seems appropriate given their track record. So I like this stock. Let me know what you think on Lululemon. Put a comment down in the channel. Help me with the old algorithm of Google. Share this. I'm happy to do it. If you're interested in learning more, I do a couple things. One, you can join the Cash Flow Club, where in which you will see these published regularly. You will be able to engage with the analysts myself. That's a monthly subscription. Go ahead and dive in. We had a great track record. We've got a webinar coming up, by the way. We do our quarterly webinar, so free members of the Cash Flow Club get access to the free webinar. You can ask me questions directly. I host about an hour and a half, just economic review of where I think the economy is going. Also, if you're interested in becoming a financial analyst, if you want a job in Wall Street, you want a job at an investment bank, private equity, or corporate finance, I've worked at all three. I've trained analysts over my 20-year career. I'm happy to train you. I did a simple course. It's several hours long, but I break down how to build Coca-Cola's financial statement and forecast in Excel with no mouse, building the 3 statement models, connecting them together, and showing you how to build debt schedules, amortization schedules, how to forecast. If you can do those steps from without a mouse in Excel, just using keyboard shortcuts, you can get an interview at an investment bank. And if you're looking to change your career, you want to learn more, have something more engaging, I highly, highly recommend doing a stint as an investment banker. It is a wild ride. It is tons of fun. It's a great career. You will learn a tremendous amount. To do that, you need to be able to master Excel without a mouse. I'll do a course. Check it out. It'll teach you how to the skills you need to get into the interview, and then you can sell yourself. If you don't want to do that, but you just want to learn how to forecast, I have another, cash flow investing course that simply teaches you how to do this. I give you an Excel sheet. I show you how to forecast. It's not building financial models for investment banking, but it's more like how to build a portfolio of, say, 10 to 20 stocks that you have models for that you track on an ongoing basis, and you build your wealth yourself. So I highly recommend both. Depends if you're looking for, hey, I want to do it myself, or hey, I want a new job. Like, they're just 2 different courses, but check them out, cashflowinvestingpro.com. And again, email me if you're interested in becoming an analyst at the Cash Flow Club. I'm happy to teach you how to do the work in exchange for publishing your work in the Cash Flow Club. Thank you very much for the time. Again, Lululemon, very interesting stock. Check it out, and let me know what stock you'd like to see next. I'm happy to take recommendations. Thank you very much, and bye-bye.